Thank you very much, and thank you to Gregory for inviting me. There should be some slides coming up in a minute, or at least one slide. I only have to try and get this device to work once. I don't know if it is going to come up. Anyway, there we go, perfect. Hopefully the text, I'm sorry, it's too small to be visible at the back, but it's just a summary of what I'm going to say. So the first thing I would ask you to note is I was asked to come here and talk about helicopter money. There's no mention on my slide of helicopter money, because I've realized if you want to do anything in central banking, you have to obfuscate. So if you want to do helicopter money, you definitely don't call it helicopter money. And in fact, what I'm going to argue is that we're already doing helicopter money, just very incompetently. And my recommendation is let's do it competently and let's do it effectively. But that's the last mention I'm going to make of it. We can maybe come back to it in the Q&A. Right, so the first question is, what is the challenge facing monetary policy? And I think it's crystal clear what the challenge facing monetary policy is, which is the impotence of the monetary authorities. And I totally agree with Athanasios that it's, in my view, a moral and intellectual scandal to have central bankers now saying we need help from other parts of the economy, when we all know, if we're honest as economists, we spent the last 30 years saying that central banks should be independent and that inflation is everywhere a monetary phenomenon and that we're entirely able to manage aggregate demand. We can't wait until we fail and then say it's somebody else's responsibility. And I also just simply don't believe it. I don't think it's intellectually honest. Now, I should stress right up front, as we saw earlier, I'm quite optimistic about growth. But we should absolutely not view recovery in our economies as being indicative of the success of our policies, because it's not the outcome, it's how quickly you get to the outcome and at what costs you've borne in the interim. And I would say we've all singularly failed because the recoveries everywhere, bar perhaps China. I would say the Chinese have illustrated cyclical economic success in that their recovery was very, very rapid and immensely powerful. But everywhere else, the recoveries have been very slow. So we can't really pat ourselves on the back just because we've got recoveries. It took us too long. Now, policy shouldn't be based on optimism or hope. Policy has to plan for the worst, and the worst is clearly a recession. So I want us to genuinely pursue the issue of what policies do we think central banks could implement if we were hit by a recession currently. Now, I also want to suggest to you that there has been some profoundly important innovation in monetary policy. And I'd be very interested to know who at the ECB deserves credit for this, because I think that TLTRO is far and away the most important policy innovation since the financial crisis. And that's what I'd really like to argue in the next few minutes. And the reason for that is I think the TLTRO is virtually limitless. And I'll go through why I think that is the case. Or at least, let me put it like this, I think it reduces our problem to one of administration. Right. It potentially solves the administrative problem. So what have the innovations been since the financial crisis? QE, forward guidance, TLTROs, TLTROs, again, it's a fabulous example of making sure that when you do something profoundly radical, you give it an acronym, and your explanation of it is baffling. If anybody actually goes and tries to understand what a TLTRO is, they won't be able to make head nor tail of it. I'll explain it very, very briefly. It is more complicated than this, but this is the principle of a TLTRO. It's lending by the central bank to the real economy, intermediated through the banks. Okay? And that is actually being done by the Bank of England now with the TFS scheme. And in fact, the Bank of Japan may have been the first. The Bank of Japan's been doing some amazing innovation, because after Fukushima, the Bank of Japan started to lend to the banks for specific lending purposes. Now, the other profoundly important innovation that's occurred is absolutely the introduction of tiered reserves. But more important than just tiered reserves is the idea that the central bank has more than one interest rate. Right? That is profoundly important. As soon as you recognize that there's more than one interest rate, you realize the power of monetary policy. I'll give you a very simple example to illustrate this, and I think for me, this kind of captures a lot of what Miles is. Interesting to me that Miles is kind of advocating multiple interest rates. But let me give you an example. The Chinese used to, only a decade or so ago, they used to own their commercial banking system. Right? So the commercial banks were part of the state. So the state ran monetary policy. The state set deposit rates and lending rates. So there are effectively two critically important interest rates in the economy. Now, how do you guarantee, if you think of Miles' models, that we're going to stimulate the economy? Well, instead of making a neutral transfer, in other words, changing the deposit and the lending rate by the same amount and then hoping that there's differential marginal propensities to consume and there's no problems with intermediation, let's raise the deposit rate, okay, so that makes a transfer to depositors, and let's cut the lending rate. Right? It's nirvana for everyone. Now, of course, what that means is you run a negative net interest margin within the banking system, which is precisely what the Chinese did. And of course, you can generate whatever level of nominal demand you choose to generate. And that is printing money and distributing it via dual interest rate. So once central banks have started to introduce dual interest rates, they have a monetary bazooka. And the ECB and the Bank of Japan have both done this. So one of the critical arguments I want to make is what's interesting about TLTROs in contrast to QE, although I broadly agree with everything Anathios was saying on this, is that the marginal impact of TLTROs increases dramatically. Whereas the marginal impact of conventional monetary policy, i.e. interest rates, the marginal impact of QE diminishes very rapidly. And I'll hopefully be able to illustrate that. Very briefly as an aside, I think the greatest clarity comes from reading on this entire subject the first 2 pages of Milton Friedman's 1968 AER address. I recommend everybody to reread it. It's famous for its comments on the long-run Phillips curve being vertical. That's not what's interesting anymore. He gives you a 2-paragraph explanation of secular stagnation that's better written than anything Larry Summers has ever produced, right? And it was done in 1968. He also explains very, very clearly when you've got plentiful reserves, there's no point in doing QE. Because what he makes very clear is there's no wealth effect. You're simply substituting one asset for another, right? So QE is very, very simple. If I'm the financial sector, you're taking a bond from me and you're giving me cash. My net assets are unchanged. So Friedman's absolutely clear, when interest rates are zero, when there's huge amounts of liquidity and there's no term premium, there's no point in doing QE. But he says there's a critical difference if you just gave me cash because my net assets would increase. So he actually believes in the Pigou effect, and he's absolutely correct. We've just all been taught a stupid Pigou effect, which is the idea that if there's deflation, real money balances go up, which stimulates demand. That's not clever Pigou. The clever Pigou, which Friedman actually attributes to Haberler, who, if you're like me, you've never ever read any Haberler, is actually that if you can increase the monetary base, and effectively you don't buy people's assets, but you effectively give the private sector, you make a monetary transfer to the private sector. If you continue to make a monetary transfer to the private sector, you will increase their real monetary balances unless you get inflation or higher nominal demand, which is why actually the Pigou effect is very, very powerful. Now, the first point I want to make, and this is where there's kind of hidden helicopter money, is actually all of these policies, QE, TLTROs, tiered reserves, and I suspect what Miles is suggesting, are actually all of the same thing. They do 2 things. They alter the price of credit, and I don't want to talk about that because I effectively think that game is over, right? The problem is not that interest rates aren't low enough. But the other thing they do is they transfer money printed by the central bank to the private sector. It's as simple as that. Now, take the QE point. I can illustrate, let's say Milton Friedman's in the room, and he says, okay, what you need to do if you want to hit your inflation target in Europe is you want to do a helicopter drop of €1,000 per adult citizen. And I kid you not, it's going to work. And by the way, we've got loads of empirical evidence that it works because it's just a tax rebate. The Americans are geniuses at naming things. If you call something a tax rebate, it's actually an honest, moral high ground because you're giving good citizens back the taxes they pay. If you call it a helicopter drop or something else, people say you're getting money for nothing, right? So naming and framing is everything. So let's I don't know what they are, some kind of European citizens dividend. So Friedman says, don't you worry, we've got all the evidence you need. Look at tax rebates in the States. It affects the economy. The only question is how big the multiplier. Better evidence than QE, better evidence than negative interest rates, better evidence than anything anyone has ever done because we've got lots of studies and we've done it on lots of occasions. But then you say to Milton, sorry, there's a problem with that. We don't have any helicopters, so we're not sure whether it fits in our mandate. The only thing we can do is QE. That's not a problem. Is that I can give you a helicopter drop with QE. So the way I do it is I say, how much do we want to distribute? I'm going to simplify the numbers here. Let's say we take the Eurostoxx. That's the index of European equities. And let's say it's currently got a market cap of 10 trillion euros. I want to do a helicopter drop of €1 trillion. So what I'll do is I'll buy all the equities for 11, and then what I'll do is I'll sell them back to you a day later at 10. So what's happened to you? Okay, now, bear in mind, this is a critical point, this analytical error is made repeatedly by central bankers when they talk about QE. They all say they don't want to make a loss in their balance sheet. The only difference between making an actual loss on your balance sheet and doing QE is the loss on your balance sheet with QE is contingent, right? You are expecting to make a loss if it succeeds. So you have an extraordinary comment by the Deputy Governor of the Bank of England who says, we don't want to have a negative interest rate on our TFS, which is their lending program, because we'd be making a loss. Well, hang on a minute. What was the point of doing QE? If you're buying gilts at 0.5 after Brexit, if it works in any sense, which it has marginally, gilt yields today are higher. So you're willing to make a contingent loss, but you're not willing to make a guaranteed loss. So you could make a certain small loss or a large contingent loss. That's an absolute nonsense, and that's coming from the Deputy Governor of the Bank of England. So the key point I want to make here is all of these policies are actually about transferring money that's been created by the central bank, money that has been printed, to the private sector. The question is, do we want to transfer most of it to Warren Buffett and Bill Gates? Or can we make it a little bit more effective than that? Now, the TLTRO is actually a way to do it more effective than that, and I want to explain. So, the beauty of the TLTRO and the beauty of the evolution of the TLTRO is, so what is the central bank doing here? The central bank is saying, I'm going to lend to you the banking system at an interest rate that I've now separated from official interest rates. This is no longer necessarily the deposit rate. This is no longer a money market interest rate. I'm just going to determine this interest rate as I see fit. Okay, which means I could set it at 0, I could set it at -4, and I don't change any of it, so no savers are up in arms. Nobody in Germany is crying wolf and panicking. I'm going to set a separate interest rate on the TLTRO. The other thing I can do is I can extend its maturity, because the maturity has been extended. So I've got a second axis. I could suddenly make a 10-year loan at 0 or a 20-year loan at 0. And then the final thing is I can decide what it's going to be used for, and I can decide how much. Right. Well, to cut a long story short, if you don't think that's powerful, look at the extreme. And this actually isn't even the extreme. The extreme, one extreme is a perpetual loan at 0 interest rates. So I say to the banking system, I'm going to give you €1 trillion of perpetual loans at 0 interest rates, and you have to do all of the hard work for me, which is the only people who are eligible are European adult citizens. And we work out exactly how much that means per capita, and you're going to distribute it through the TLTRO. Now, if there's any advocates here of a thing called basic income, they could even generate basic income if they wanted to, because they could say, you know what, we'll do a perpetual at a negative interest rate, where you get paid a certain amount of money every year. So the key point I want to make here is that we have got grotesque obfuscation going on, right? The reality is the unconventional means interest rates don't really work anymore. We're now going to transfer money to people. We're doing it in a dramatically incompetent way that is confusing to everybody. We should do it in a much clearer, honest and fair way. And we have somebody very, very small, the ECB, has come up with 3 axes which you can just incrementally continue to expand. So there is absolutely no reason why the ECB can't generate nominal demand, can't hit its inflation target, and can't bring European unemployment back to full employment.
Okay. Okay, thank you very much.
Well, the first thing is very clear. I need to go on a diplomacy course. Because the first point I would make with all of the questions is you're not comparing the policy proposal to existing policies. So on all of the observations you make, I would say the ECB has already grotesquely breached those standards. So if you say, what has happened to the ECB's independence through the euro crisis? Well, chronic damage has been done to the ECB's independence. We have the ECB intervening in political elections. I mean, they intervened in the Italian election. They arguably virtually publicly expressed a desire for a change of a national leader. In Ireland, on a side of A4 paper, they described what was to be done to the Irish economy. Where is that in any treaty? The ECB within Germany, in terms of negative interest rates, to me, are a disastrous idea. They are a huge experiment. They are hugely unpopular. So the politicization, independence, funnily enough, the proposal that I'm making would be deeply popular, right? It is possibly the only monetary policy proposal where European citizens would go, actually, this European enterprise might just be working in my favor for once. Now, As to the empirical evidence, so first of all, is it irresponsible? You see, we've had a lot of major irresponsibility so far because we have deep antipathy towards the European project because of the euro crisis and because of the slow recovery. We have an observation that technocrats, unelected, Mario Draghi is the most powerful person in Europe. He determines the fate of nations. Right? That is dramatically undermining the political legitimacy of what we're doing. So now, is it irresponsible? Let's measure that on two standards I would give you. How much balance sheet would be required? So the financial risk of what I'm suggesting, and how much empirical evidence do we have that it works? Right? We have vast amounts of empirical evidence because all I'm describing is a transfer. We have loads of economic evidence. We don't need to worry about, you look at American tax rebates. People who are leveraged, yes, they do. People with low incomes, living hand to mouth, they spend more. People on high incomes save. We know this, and we know the range of the multiplier. We know nothing about negative interest rates. We know very little about QE, all of these other monetary experiments. The balance sheet that I'm talking about, if you use standard fiscal multipliers, you're talking about 3 to 5% of your balance sheet. The only difference is I'm being transparent. So what I'm suggesting is the central bank is going to lose, in inverted commas, for whatever that means, 3 to 5% of its balance sheet. What everybody else is proposing is we're going to hide those losses. So we have backdoor fiscal monetization. See, I hate to say it because I'm pro-European. I think the OMT looks illegal. I think it's very debatable whether QE. I think the SMP program, those are highly debatable. However, if I say central banks throughout history have made loans to the banking system, and what we're going to do is we're going to do a loan to the banks that's going to be an equal distribution at 0 interest rates as a perpetual to all European citizens. That is, I've got no governments involved. I don't have any conversations with anybody. I'm certainly not parts of troikas telling people what to do. And do you know what? The Germans, interestingly, will be the biggest financial beneficiary by amount. I suspect all of the Germans will take it up, and if any Germans don't, they should just go on a basic financial literacy course because it's a pretty good deal.